Corporation says it's well positioned to fill some of the gap if CIT does in fact go away. Well, let's find out the details. Joining us now is the president and CEO, Leonard Tannenbaum. You also have Josh Rosner of Graham Fisher. Leonard, so good to have you with us. Should we just send all these applications and all these potential customers to you? Is this, you're going to take over CIT's book?
Oh, we only have $300 million in capital available. We don't have that kind of money. But for the deals that we're in, that CIT is not in, is in but failing in, we will go ahead and step in and fill the gap. And one of the examples is Rail Acquisition Corp. We do the linear slides for a Dell server rack, for example. It's $10 million factoring with CIT. It's going to go away. So somebody has to step in temporarily till the factoring is taken over by somebody else.
How long is temporarily these days? This could turn into something permanent, don't you think?
It's okay if it does. These receivables are backed by Dell Computer, so we're very happy to step in. We're expensive, but we're happy to step in. CIT's at 6%, we'll be at 12%. It's a very different argument on price.
That is a very different argument on price, isn't it, Josh Rosner? Exactly. It goes from 6% to 12%. Right. Imagine getting that bill in the mail. So what happens? Credit's more expensive.
Credit's more expensive, which goes back to the no one can fund further out on the curve. Everyone has to come in closer on the curve. You've got real questions at some point. If all the demand is at the short end, does the Fed continue to actually be able to control the short end? Quantitative easing actually isn't working as well as it was. The last round of it was, sort of limited success. The discount mechanism becomes, to some degree, theoretical. Let's see if it can hold as you've got all the demand at the short end. And I think we have to start thinking about the risk that, yes, we've got a steep curve. Does it actually become a flattener with the short end starting to move up? And with so many businesses becoming so reliant on low-cost funding, how many of them actually can still have positive margins in that kind of an environment?
Leonard, what are you seeing? If this is something that's going to happen in the future, are we going to see a flat curve? I love that term.
I don't know that we're going to see a flat curve.
Flattening, I said.
All right, flattening.
Flattening, maybe not a flat curve. As we roll debt forward with 30 days, every time you have to make a decision, do you want to roll for 30, 60, 90, or whatever? We're being told by Wells Fargo, just did our offering, and UBS, keep it short, keep it on the low end of the curve, don't swap it out yet. You're going to continue seeing the short end of the curve be
This isn't de-risking, this is no risking.
Yeah. They're trying to pump up the banks with liquidity. The banks are not yet lending, but it's getting a little bit easier.
Well, that's actually the funniest part of all of this, right? We keep talking about the steep yield curve being beneficial, but at the end of the day, if the banks aren't lending, you only actually benefit from a steep yield curve if you make a loan.
But they're starting to. They're starting to.
Well, except they're not in the small and medium-sized enterprise market.
That's supposed to be Leonard's job.
That's right. That's what creates our opportunity.
That's absolutely right, although a small player.
Right.
And that's really the issue is the regional banks, this is their bread and butter. And so in some sense, we're seeing a transition from the large banks to the small banks in this crisis. And we're seeing the smaller banks pull back from that because they're seeing their commercial, their construction, their development loans going.
They have no loan capacity
You saw the
anymore.
Same thing. If you look at 01, 02, 03, the banks went to about 2 or 2.5 times EBITDA. And then they expanded to 4, 4.5. They took the stretch pieces. They took the cash flow pieces. Now they only want to do asset secured. They want to stay really high in the structure. Huge middle void in terms of that's why M&A activity is down so much. Even though you're right, we have capital. We have only $300 billions of dollars are needed.
And what are you hearing from the customer side? Are they quaking in their boots?
They're surprised, but it didn't happen overnight, right? Started about a year and a half ago. The credit dislocation probably started in July 2007. It got accelerated through 2008. Yeah, maybe even before it really started. You're right. The crack started.
Look, we saw all the warehouse lines to the mortgage originators start going in the third and fourth quarter of 06.
That's right.
By February of 07, we had already seen about 80 lenders shut. And so I think actually we've misdated this entire crisis all the way along, which is part of the reason the government's response was so late.
But sure.
So now what have you got the situation where even the credit lines that haven't been pulled, the lender's pulling them?
Which is what we saw, by the way, on the consumer side. In the fourth quarter of last year, we saw $365 billion of committed but undrawn lines of credit in the form of revolving credit cards get pulled from consumers. That actually gave us the next leg of of credit quality deterioration in the consumer segment. Here what we're talking about is small businesses. At the end of the day, the feed-through effect of that is magnificent, right? You've got small businesses, you're going to see rising delinquency and default, you're going to see record bankruptcy in small businesses, I would suspect, in the next 6 months to three quarters. At the end of that, you've got commercial mortgage problems actually accelerate. We've already got problems there because of this.
You seeing that?
No, I don't agree.
No? Why?
I think maybe with the small businesses he's talking about are really small mom-and-pop stores and $1 million, $2 million revenue companies. Look, we have 45 companies. We talked about an index on Bloomberg, I don't know, a month or two ago. We're seeing increase in EBITDA across the portfolio. Now, I think small businesses reacted to this so quickly by cutting costs. They react faster than large businesses. So I think the recovery...
What does that do to jobs? Because that comes back to the beginning.
I'm hiring. I'm hiring 7 people. We'll come to you right after the segment, and we'll ask you if you have some references. But we're hiring. There are other people hiring. Our businesses are hiring. With Lighting by Gregory here in the city, that's hiring. It's just starting to turn. Even the consumer side is starting to turn.
So this was a time buying exercise, at least right now.
But up until now, no question about it, small businesses suffered.
Okay, all right, we got to leave it there. I want to thank you, gentlemen, very much. Josh Rosner coming in from Graham Fisher, Leonard Tannenbaum coming in from 5th Street. Appreciate you sharing your thoughts with us, and I'm sure this credit crisis is not going away. So look forward to having you both back with us.
Thanks, Ben.
Coming up.